Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey, good afternoon, everybody. This is David Blake, and this is Tech Talk Tuesday. This is your first time attending. I want to thank you for joining us. And we usually go about 20-25 minutes talking about some charts and sectors that look good to us. At the end of the 25 minutes, we'll open it up to questions. We can ask anything about individual stocks, sectors, the broader market, whatever's on your mind. This week, we're going to touch base on different sectors that actually should outperform during a rate hike cycle, which we expect will start in December. All right, let's get started here. After 6 consecutive weeks of gains, towards the end of last week, investors started to pull some money off the table. Yesterday, we had one of the worst days in the Dow that we've had in about 6 weeks. After Friday's jobs number last week, the initial reaction by the market was rather muted, and the market was just kind of drifted a little bit lower into the weekend. The momentum index, the market edge momentum index, actually strengthened last week. It moved from -5 to -3, which is neutral. Internal breadth numbers improved, although the number of new 52-week highs is still rather anemic. And also the advanced decline line for both the NYSE and NASDAQ are higher, but way off the levels we saw this summer when the averages were recording new highs. I'll show you later with the chart that we look at almost every week. The NYSE AD line, which peaked on April 24th at around 333,000, closed yesterday at 325,000 roughly. That's still about 8,500 units shy of towards the high. And the NASDAQ, which yesterday, I believe, or Friday, was only about 1.5% from its high, that AD line is off about 13,000 units. So you can see that that is a leading indicator. You can see they're starting to put up a little bit of a red flag that shows the thinness of the rally. It is a leading indicator. We should see that heading towards its old highs, which we don't. That shows negative divergence in the last week and a half, and going forward, we want to keep our eye on that. Okay, last thing to bring up about the October's rally is that at the close on Friday, once again, this market has gotten expensive. And looking out over the trailing 12-month earnings, which historically, over a 5-year period, it should come in around 14.1, and at 10-year average is about 13.2. We're back up on the S&P 500 right around 22. So that 15% spike off of the September low has put us in not overbought, but in expensive territory again. Okay, in the summary of the market, we talked about a new cycle of rotation in different sectors that'll probably be taking place, and that's what we want to talk a little bit about today. We're going to look at some different works and charts from technicians like Chief Equity Analyst Sam Stovall over at S&P Capital IQ. And just kind of look at over the last there's been 7 different cycles since 1946 where we've had a rate hike start. And there are a few sectors that we want to look at that have outperformed, and there's some other ones that you may want to lighten up going forward. Okay, first let's take a look at a few of the different indexes, see what we can expect, where support might come in on this little bit of a pullback. And I kind of expect the markets to kind of tread sideways to lower over the next week or two while some other economic numbers come in to see just kind of pinpoint that Janet Yellen and the Fed are going to raise rates in December. We have something called the CME Fed Watch, which we look at and quote once in a while. Previously to the last FOMC meeting, there was about a 45-50% chance, according to the guys who put their money where their mouth is, that there would be a December rate hike after Wednesday's testimony before on Capitol Hill. That number is back up to 70. I think today it was at 68%. So it's pretty much a given that we're going to see a rate hike in December. Okay, here's the Dow Jones. I tried to do a little bit different label here. You can see off of the September low, we've had a heck of a almost straight up run. We were able to capture the 200-day moving average about a week and a half ago. The last couple of days, we've kind of drifted below that trend line, and we've also we're kind of coming down towards support down here, the 200-day moving average. I'm not sure that's going to hold or not. Part of that kind of depends. If we see that break below that 200-day and volume starts to pick up, you might want to be a little bit careful. I would say our next line would come in down here around 17.2, which is back here, which we had a little bit of resistance going up. Breaks that, we'll be back here at the 50, around 17,000. We're also seeing some negative divergence here on the 14-day RSI. You can see while the market's still pushing to new highs, the RSI, I mean, showing the momentum is getting a little bit weaker. And also, I believe yesterday the MACD actually gave a sell signal for the Dow, which is kind of showing a little bit more weakness than what we actually wanted to see. The S&P 500 is almost the exact same chart. We ran into resistance up here around 2100, 2110. The 200-day moving average on that is right here around 2065. MACD again went bearish on the S&P 500. A little bit of negative divergence, not much on the 14-day, but we do have some. And I would expect today we're at 2075, so we're still holding above the 200 today. I would probably see this come down around the 2025 area. Would be the next level of support. We'll see if we can hold that. NASDAQ, same thing. We've had it outperform, had this big gap up. First thing you want to check out on this is whether or not this will come down to where the gap was in the NASDAQ. If that doesn't hold, it'll fill that gap, which often happens, and that would take it back down to the 200-day moving average, which is right around 49.50. So that's a real possibility. We'd have about another 100 points to go lower on that. RSI, the momentum looks a little bit better on the NASDAQ, but MACD is also getting ready to give a sell signal on that. Russell 2000, last week we had a great week. It was probably one of the best weeks we've had at Russell. It was up about 3%. Couldn't quite push up to the 200-day, so we're kind of stuck in between here. A lot more divergence showing up in the 14-day RSI, as you can see over here. What this implies is that we had a nice run with the momentum into this, but as we broke out again, it just didn't have the oomph behind it that you want to see when a market's making new highs. And again, the MACD is bearish on the Russell 2000. So when the rates go up and you see a little bit of a stronger dollar outside the U.S., you do want to see the Russell 2000 and smaller cap stocks outperforming. That could still be the case. They can come down here and get in this consolidation area and find support. We could see the Russell 2000 start to lead the other indexes higher going forward. Okay, this is one that we keep looking at. I keep telling you, once we see the transports break out, then that's going to kind of ring the bell that we can really see this thing start to move. Again, it keeps coming up here around this 8,300, bounced off there several times. We have support down here off this trend line at around right around 8,200. Came down yesterday in the sell-off, almost touched the 50-day. Then we had some merger and acquisition talks in the railroads, which sent the transports back up. But they were having a bad day. They were off almost 2.5% midday before we saw the railroads take off. So we still want to see this, get up here near the 8,400 before that we can really see the other indexes go. And then we also we want to see participation by the semiconductor stocks, and we're just not. We had a nice move off at the bottom here. This is about a 22% move, and now we've kind of stalled out here right around the 200-day moving average. Again, we have negative divergence on the RSI on that too. So a little bit of problems in here while investors basically are digesting what it's going to mean to portfolios with a December rate hike. Okay, this is what we just talked about a little bit ago. Here's the NYSE advanced decline line. This was had a double bottom in here. We started making higher highs and higher lows. We've had some. You can see a pretty good pullback on this the last couple of days. It's negative again today right now. We'd like to see this catch if this is going to find support in here. Now again, I think it's off something like 12,000 units. Here's the NASDAQ. again, this was a well, this was going sideways. This index was up almost 15%. That shows you the thinness of the move, led by the Facebooks, the Amazon, the Google, Microsoft, and like that thing. We want to see more participation in that before we can get excited about the market going forward here. Okay, this next chart is one that you might have seen before. And what this does, this is showing the basically a four-year market cycle, where you're in a recession, you start to get an early recovery, you move up into the full recovery, and then the Fed comes in and starts to, we start going in an early recession, and the Fed will come in and start cutting rates. So what I would look at right now, normally you're probably over here in the early recovery. We're probably a little bit further along in the recovery because it's been going on for about 4 years. But normally we have that 4-year business cycle. Unfortunately, once they took their interest rates down to 0%, they eliminated the average business cycle. So these sectors at the top here, where they should be outperforming, are not going to quite gel with what normally you would have over the last couple cycles. But it's still good to know this thing and keep this chart in where you can keep it handy. Anyway, the normal business cycle, once the economy is starting to kick in, you're going to see the basic materials, energy stocks beginning to outperform. And in this case, it's not happening. And the reason for that is quite simple. It's mainly because of the strength in the U.S. dollar. The U.S. dollar is bad for commodities, which is the materials. That's your lumber, your copper, that type of thing. And you're just not. The strong dollar is going to put pressure on that going forward. It also keeps pressure on crude oil. So in this case, although I think the energy stocks will come around as we start, especially if we start to see China pick up a little bit in their economy, I'm not expecting the staples to really participate. Now, once you get up here and the Fed's already is raising rates, then people get more defensive. That's consumer staples. They call that, you're going to smoke, you're going to drink, you're going to do everything else when the economy's starting to roll over. Healthcare stocks, another defensive sector. They also will outperform once the thing reaches full recovery. And then once we start to go down and they start cutting the rates, the financial stocks will come around a little bit on that. Now, what's going to be different about this recycle? Again, number one, we're coming off of 0% interest rates, and number two, the excessive strength in the dollar is actually going to weigh on, is going to push some of these sectors out a little bit. Okay, this chart here will also tell you where in the cycle what you want to be invested in. In this case, normally it would be commodities along with the stocks, because as the economy strengthens, of course, you start producing more goods, which means you're going to need more copper, you're going to need more lumber, you're going to need more supplies, and that's not happening in this case because of the U.S. dollar. But the stocks should outperform here once we get a little bit more participation from, say, Europe and from China. And then once we get over here, you'll start to see the cycle roll over. And perhaps once the interest rates, we can actually get up to about 2% on these things before it's going to cause much of a slowdown. But this would be another chart that you might want to keep around to see where we are in the economic cycle. Okay, this next chart is let's see. This is all we talked about. It's all about the U.S. dollar. This is the dollar down here, as you can see, where we had this big spike up and a little bit sideways, and now we're started up again once the December rate hike got on the track. And what this is comparing how the dollar goes, and this is how bonds are. As you can see, there's an inverse relationship. The dollar's falling, bonds are going up, which means the yields are coming down. And now, as the dollar's starting to get higher, this is going to pull over, and it's going to show that the yields are going up. We're seeing the stochastics are in here. We're not overbought in the dollar or anything like that yet. The RSI is just starting to pick up some more positive momentum. So the closer we get, the more assurance we get that the rate hike will be coming in December, the dollar should come up here and break out to new highs in this area. And again, it's probably going to weigh again on the broader market, especially with the materials and that type of thing. Okay. Speaking of materials, here's the materials sector. Again, we had a heck of a rally off of this. It was so oversold. This is a 30-day stochastic, which I like. When that gets down there, it produces often a good buy signal. Here's the RSI. You're starting to see negative divergence in this, just like some of the other things. MACD short-term has gone to a sell. Again, this negative divergence shows as this last pop-up here, it just didn't have the oomph behind it. It was a lot thinner of a rally, and now we're starting to roll over, and I would expect that to probably come back down here and test this congestion area over here. The energy sector, same story. Again, a big negative divergence, especially in this last move up. Couldn't even make it up to the 200-day moving average, and I would expect to see the energy cycle or energy sector come on back down here and test this 50-day. We also saw the last couple of days the crude oil fall back below $45 a barrel. That seems to be the line in the sand. As long as that stays below $45 a barrel, you're probably going to see further weakness in the energy sector. Okay. Last thing I want to talk about, once the interest rate cycle begins, we've gone back, we've had seven cycles since 1946 where we began to raise rates. And believe it or not, 6 months after the S&P 500, the rate cycle starts, the average return is only 2.6%. So as you can see, we're not expecting, even though I think the bull market is intact, it's going to be a lot. The last year has been pretty slow, but I don't expect to see this thing go gangbusters at this time. And if you look out even over the next 12 months since 1946, the average return has been about 6.2%. So the market doesn't like the start of a rate hike cycle. I would expect you to start to see some selling going on here. I just think it's going to trade sideways to down. The sectors that we look at that will benefit from this, from the rates, in this case, financials will. Now, normally, believe it or not, financials don't do that well at the start of the rate hike, but this time the bank stocks, whether it's regional bank stocks, are undervalued. They're discounted because of what the rates have been with the 0% rates. Your online brokerage firms, your TD Ameritrade, Schwab, Z-Trades, they perform very well during this cycle because they don't have a lot of bricks and mortars. They have all that money sitting in accounts, and they can start collecting more interest on that. Morgan Stanley, Goldman Sachs would be good. Most of these stocks, if you look at charts on them, they had a nice rise into August. They took it on the chin in August and in September, and they started to rally back now with the rates going up, but they're still not where they were in August. So I would be buyers of these stocks in that. Okay, finally, let's see. Okay, just to wrap it up, because again I've gone a little bit too long. It's 20 minutes. We're likely to struggle in here. I want to try to get pull up the charts here if I can. Let's see here. I can get to the. You see the iMeet thing for the charts. Can you see this chart over there? No, you can't. Sorry about this. I'm trying to get the setting. Here we go. No, that's not it. Okay, this thing. Here. Is it up here? Yeah, here it is. Okay. We're going to so we can share the screen here briefly. And I'm just going to allow you to, down here in the lower left-hand corner, you can start to ask some questions about the different stocks, individual stocks. We'll take a look at that. I don't see any thing in the chat. Okay, here we got one coming up. Okay, how does Facebook look after the earnings beat? Okay, let's go over to this chart. Okay, here's Facebook over here, and this is going back about two years on this. As you know, they came out with some blowout earnings, gapped up, and what you see over here often when a stock gaps up, what will happen is you'll see the price come down here and fill the gap. It looks like that's what's going on with Facebook. If that happens, you'll get a chance to buy this probably around 102, maybe 100. If you look over the last couple of years, every time it's had a big gap up, it's traded sideways and drifted down over the next month or so. Here's one over here. Here's another. This one gapped down, but here's another gap up. Kind of came down, went a little bit sideways. Here's another one where it gapped up a little bit and it came back and returned. So I would probably hold off. If the overall market's going to pull back a little bit, you might get a chance to buy Facebook a little bit lower. I would be a buyer of this though, anywhere around 102, 101, and at that area. Okay, COP. Would you buy here or wait for a pullback? Okay, ConocoPhillips. I would be a seller here of the oil stocks. We've talked a little bit before. I thought you could get a nice trade out of them. You have traded. You came up short of your 200-day. You've seen a lot of negative divergence here on this last run on the RSI. It's a little bit overbought up here in the 30-day also. I would expect to see the oil stocks, including Exxon and Chevron and all those, probably pull back in here to the 50-day or lower. I'm taking profits in oil stocks on this last rally. Okay, what about Bank of America or Wells Fargo? Would you consider either of them solid buys? I like the banks. Like I say, most of the banks are trading at a discount. Here's Bank of America. Let's look at a little bit shorter time frame. Here's over 1 year, 6 months. You had a gap up over here. You look like you're going to fill this gap over here. You do have support down here in the low 17s. I'd be a buyer of that. Momentum's kind of flat, but the MACD on the trend is definitely up. Again, you're probably going to get a run of this thing up in the 18s, especially if we start getting some stronger economic data. These stocks are trading at a discount from where they normally would trade, so some of these things are basically at trading below book value. Wells Fargo, another one, had a little bit of a gap up here above the 200-day moving average. It filled the gap, and again, this is a good example of what Facebook will probably do. We'll have to watch it. If it breaks below this 55 area, you can probably buy some shares down in here around this 54 where support is. Again, I'm a buyer of the banks. I think they should perform well going forward. How do you feel about tech and biotech? Okay, let's look at on the biotech side. Let's look real quickly at here's the biotech index right here. This is the NASDAQ biotech. This represents right here about a 32, 33% dip. You're starting to get some people dying. They've had enough. You got positive momentum. The 30-day stochastics is giving a buy over here, and MACD is still bullish. I like the biotechs at these prices. They've been beaten up so much. I would be selective whether you buy a fund or whatever you do. I think they've been punished enough that part of this punishment is the talks of the drug price gouging with the drugs on Capitol Hill. That may weigh on them for a while, but I think if you're buying some good, some of these biotechs, what they're coming up with is going to, for years to come, they're going to be curing cancer and everything else. So I do like these. Now here's the semiconductor. You just made it back up to the. We looked at this earlier. I like technology stocks, and technology stocks, even when rates start to go up, you do see them usually outperform in the past. So I do like that. I would like to see the semiconductor stocks break back above this 200-day. They can break above 680 on the Philadelphia semiconductor. That could start another run up. But again, look at the negative divergence down here on the RSI. While this thing's going sideways and trying to make a new high, you're just not getting the participation. So while the broader market consolidates, you're probably going to have some more consolidation in that section to boot. Okay, comments on J.P. Morgan. They're going to be good. Actually, J.P. Morgan is one of the stronger stocks out there. Again, you had the gap up. A part of this gap up is because people are anticipating that the higher rates are going to be good for the bank stocks. You're kind of filling this here. Part of this may be because people are seeing that the rates have to go up a little bit more than just a quarter point for the banks to really generate a lot more capital. But they're going the right way. Again, it hasn't even made it up to the midsummer highs. So J.P. Morgan looks good. The momentum seems to be working its way higher, and of course the MACD down here definitely bullish still. Comments on DDD. If this was upside down, it'd be looking great. Let's see, 3D Systems. You got a broken stock. You're trying to find a bottom down here at this $10 thing. What's it doing today? It's we're down another quarter today at 984. I'm not a big believer in trying to catch the very bottom of something. I would rather buy this even though it's a $9.80, $10 stock. I'd rather buy the stock up here around in the 11s on the way back up where it's challenging the 50-day moving average, and where you might see the RSI starting to get a little bit of positive momentum. At this point, you're buying it and hoping. Time for one more question. I don't see anybody typing. Hey, I appreciate you joining in. If you have any more questions about what we talked about today, or you want to dig a little bit deeper, you can email me at the doc@marketedge.com, or even support@marketedge.com. Here's one comes in about utilities. That's an easy one. Utilities do not do well with rising rates. Also, dividend stocks don't do well. Okay, here's where we got thinking that we're going to raise rates. Boom. That's what utilities did right there. So utilities, you probably want to lighten up. They're going to be oversold. If you're looking for some dividends, wait for them to bottom out, and then you can buy the stock for the dividend. But they are not a place. Look at the momentum on these things just falling out of bed. You don't want to be in. You're not looking to buy utilities at this point. If you haven't sold them already, you can hold on for that dividend. But REITs are another one. MLPs, stocks like AT&T. These are not places where you're looking for big growth at this point. Go short. I don't think this is a market that you want to short in here. I see it going sideways to down, but I think if we see the economy starting to pick up, then you're going to start seeing some movement in the small caps, and then I think you'll see the industrials, especially the ones that don't have as much exposure overseas. You'll start to see a pickup, like Caterpillar, things. Those industrials that have more than 50% of their business outside the United States. A little bit hesitant on that until we see the emerging economy start to pick up. That's when I would start to buy some of the big multinationals. But no, I don't think I'd go short, because I'm probably I'm thinking you're probably going to go on here maybe 400 or 500 more points, and then you'll try to go sideways and try to find a bottom in the broader market. Okay, I'm going to wrap it up like that. There'll also be on the markets page on the Market Edge. You can also click on that and hear this again if you came in later, you missed it. Thanks for joining us, and we'll talk to you next week.